Professor Sean Varhey from Warwick Business School. I'm chatting today with Lean Lorries, Senior Research Economist at the Bank of England. We're talking about the Monetary Policy and Monetary Analysis module, with a particular emphasis on the financial system and how the macroeconomy interacts with that. Since the global financial crisis, we've seen a bit of shift in the understanding of how that interaction works. Lean, how do you feel that kind of thinking has influenced monetary policy?
I would argue that, broadly speaking, our increased understanding of the interaction between the financial system and the macroeconomy has influenced monetary policy in two ways. So, first of all, it implies that we understand better how the economy works. And that's the case along a range of dimensions, right? So, in particular, we have an increased understanding of how the financial system can amplify the way in which the economy responds to demand and supply shocks. We now also understand better how shocks originating within the financial system can have big repercussions for the macroeconomy and so also for inflation. And then finally, we have an increased understanding of the channels via which monetary policy affects the economy. And so in practice, a better understanding of how the economy works can influence monetary policymakers' decisions. And that's because it can affect their views about the economic outlook and the risks around that outlook, and also their views about how their tools will help them to achieve their mandate. Now, in addition to what I've just mentioned, I would also say that our increased understanding of the interaction between the financial system and the macroeconomy has generated a debate about what the role is for monetary policy when it comes up to financial stability considerations.
Following up on that, I guess my thinking is that financial stability considerations have become kind of a higher priority since the global financial crisis. Do you feel that the financial stability considerations are actually impacting on monetary policy itself or inflation targeting central banks in general?
I'd say that whether monetary policy has been influenced by financial stability considerations since the financial crisis depends actually in first instance on what has happened to the central bank's mandate. So let me actually explain to you a bit more about what's happening at the Bank of England. So in the aftermath of the financial crisis, a new committee was put in place, namely the Financial Policy Committee, or the FPC for short. So the FPC's main objective is financial stability, and it has macroprudential tools such as the countercyclical capital buffer at its availability to achieve their objective. Now, the existence of the FPC allows the Monetary Policy Committee, or the MPC, to focus on meeting its 2% inflation target. But of course, it's recognized that these policies interact, right? So there is overlap of membership between the two committees to foster coordination between monetary and macroprudential policy. And then also, the MPC's mandate recognizes that there could be special circumstances. In particular, there could be circumstances or situations in which attempts to keep inflation at target are judged by the MPC to increase potential risks to financial stability. And so the mandate clarifies that the FPC's tools are the first line of defense, but that in those very particular situations, the MPC may wish to deviate inflation from target to reduce any financial stability risks. Now, I would also like to clarify that this is something that hasn't happened in recent years, despite some of the crises that we have faced. And that's because monetary and financial stability objectives have been aligned. However, in principle, it could be that at some point in future, that's not the case, and that these special circumstances would need to be called on.
So thinking slightly more widely beyond the Bank of England, obviously there's a great deal of variation across central banks, across mandates for monetary policy, and I suppose these things vary through time as well. And in many central banks, there's been an increasing feeling that financial stability concerns matter. But there's also, of course, been a lot of work from the IMF suggesting that economic growth itself is more at risk if financial conditions are weak. And so I wonder, thinking more broadly about central banks, how they're going to cope with that reduced form relationship between economic growth and between financial conditions, if it does indeed proved to be robust. Perhaps with that in mind, we should talk a little bit about how monetary policy makers' approaches have changed through time. Dealing with a period of interest rates very close to zero, and the need for alternative tools such as quantitative easing, different types of shocks are starting to predominate the economy as we're talking here in 2023. There's been a lot of discussion about oil price shocks, for example, and people are talking too about climate change and how that might result in greater volatility and greater emphasis on supply side shocks in the future. Do you feel, Lean, that inflation targeting is the right regime for conducting monetary policy in the future in the post-pandemic world?
I think, as you correctly highlight, central banks have been facing a wide range of challenges and often different challenges. And new challenges could very well arise in future. But I would argue that overall, the view is that inflation targeting in combination with central bank independence has been very successful. So in particular, and as has been widely recognized, inflation targeting has played an important role in anchoring inflation expectations. It has also contributed to reducing the inflationary impact of shocks. And more broadly, it has contributed to reducing inflation volatility. And this basically happened despite various challenges that the central banks have faced since the implementation of inflation targeting in the 90s. So, this includes more recently the financial crisis, COVID, several energy price shocks, as you mentioned. So I think there is a strong case to be made that inflation targeting remains an appropriate regime going forward. But of course, I think it should also be pointed out that there are different forms of inflation targeting, right? So some of the textbook models, they would call for strict inflation targeting, but then in practice, most central banks have what we call flexible inflation targeting. And so that's implied that it's acknowledged within the mandate that central banks should also have in mind economic growth. So for example, in the Bank of England's remit, it is recognized that there could be periods in which keeping inflation at target would generate undesirable output volatility. So, for example, and as has been mentioned in several MPC's members' speeches, if it had been possible to foresee all the energy price shocks that we have faced, then keeping inflation at target would have meant generating a considerable rise in unemployment. And so the MPC's remit acknowledges that in situations like that, allowing for temporary deviations of inflation from target is a possibility. Of course, as long as in the medium term, the MPC returns inflation to its target. I think it's also important to point out that there remains an ongoing debate, which was in large part triggered by the period that we spent at the effective lower bound about what the appropriate inflation target should be. So in particular, what people have been discussing is whether it would be desirable to have a higher inflation target, as this could help monetary policymakers to stabilize the economy. And so what I would argue is that even although the overall framework seems to be a successful candidate going further, certain parameters could be adjusted over time if that's judged beneficial on balance. And so one final point that I would like to stress, though, is that for the Bank of England, it's a key feature that it's not the bank itself who determines its regime. So that is something which is decided by HM Treasury.
Of course, yes. And you make some very good points there, I think, about the flexibility of inflation targeting and the broadness of the regime that we generally refer to as inflation targeting. We have seen some evolution through time at the Bank of England and in other countries about how inflation targeting is phrased and how it's worked in terms of operation. So I think that does give us a high degree of flexibility through time. For example, the Fed in 2020 moved to a more flexible inflation targeting framework where they're talking about targeting inflation on average through time. And of course, it isn't exactly clear what through time means. And the time horizon over which central banks target inflation does vary across country and through time. But I think that does give us quite a bit of flexibility within the inflation targeting regime. And I agree with you that inflation targeting does look well suited for what comes ahead. Okay, thank you very much for chatting with me, Lean Lorries, Senior Research Economist at the Bank of England. Very nice chatting with you. For those of you listening, I hope you enjoy the module.
And thanks so much for having me.